I'm 65 and older. And for those of us that have the traditional, the Roth and a joint brokerage account, I just was curious. I think you've mentioned before ETF 5 you recommend in a non-qualified joint brokerage. But on the TM68, TM72, and TM59, is there a particular account that you might recommend those be purchased in?
Yep. That's great. So I'm so glad to see that you're diversifying in your types of account between qualified and non-qualified account, trying to get a good balance there. Of course, the non-qualified accounts are the most free type of account. You don't have restrictions. You don't have required minimum distributions or anything like that. So I'm glad to see that you're doing that. Now, here's the theory behind the advice that I give. So when you have a qualified account that is an IRA, most of the time, all of that money has never had taxes paid on it. You got a tax deduction for putting the money in, and it's continued to grow tax deferred for so long. So what happens is that the money that you have inside that account, when you grow it, you're not only growing it for you, but you're growing it for the government as well. So keeping in mind that you're going to have to take some distributions down the road as required minimum distributions, it's good to have the slowest growing part of your portfolio and the highest income producing part of your portfolio in that type of account. Because remember, whatever you grow, you're growing for you and the government. So you want to have something in there that's going to generate some cash down the road whenever you have to take those required minimum distributions out. So the TM68 and the TM59 are great positions to hold inside that type of account because, whenever you look at the tracker, you're putting all your positions on there, whether you own them in your Roth, your traditional, or your non-qualified. So all three of these accounts make up your total portfolio. On the opposite end of the spectrum, you have your Roth account. Now, as long as the government never changes the rules, the money in that account is never going to have to be taxed in the future when you take it out. So that's the account that you want to hold your highest, your assets with the highest potential for growth, because all of that growth, the money that you put in was already taxed, but the growth on that, if the laws stay the same, will never be taxed. So the aggressive part in the Roth, the slowest growth in the IRA account, and then you have that non-qualified account. So the ETFs are great things to hold in that type of account, especially if you're using the enhanced version of it, because the enhanced version has some safety nets. If the index that it follows drops so far, it can move to cash. Now, if you make a move to cash in a non-qualified account, you could be subject to capital gains if you sell out of your positions. An ETF has a special kind of tax treatment in that this particular ETF that we're talking about that has the enhanced strategy, or the two that have the enhanced strategy, they can move to a cash position within the ETF and cause you no tax consequence. So those ETFs are great to hold in the non-qualified account. If you have more money there that you need to allocate, then you want to start looking at some of the foundational stocks, ones that you are likely to not ever have to sell and incur those capital gains on.